Art, thank you for that introduction. I'm very, very pleased to be here and honored, and have found the conference so far extremely interesting. I want to dive into the presentation because there are two of us. We have 20 minutes for both, but I'll just mention that while the presentation summarizes and represents a fair amount of work done at the BIS, it of course is not necessarily the view of the BIS. So outline, I will cover part one, which are an overview of the dollar shortages during the crisis of 2007, 2009, some BIS or work at the BIS that's looked at that, and then measures to address it, including most specifically central bank swap lines. And then Ilyak will drill more deeply into the Korean case. And the various, what happened. So in terms of the dollar shortages, using the BIS banking statistics, Patrick McGuire and Götz van Peter, in a fairly well-known paper, have documented the rapid expansion of U.S. dollar foreign claims of foreign banks over the past decade. And this particularly in the case of European banks. They accumulated them at a pace that outstripped domestic credit growth, and thus, again, to name some specific countries, UK, Swiss, German, and Dutch banks built up large net U.S. dollar positions that were, and as they generally did not have a large dollar funding base, they were funded to a large extent by cross-currency funding, borrowing in one currency to fund it in another. And maturity mismatch in dollar funding, as is discussed in this paper and a set of papers, became an issue. And both in the unsecured and the secured funding dollar markets. This is not a vulnerability that transpired overnight. In the run-up to the crisis over the 10-year period, the McGuire and van Peter document a sort of steady increase. This is from a presentation of Steve Cicchetti. He's combining Canadian, Dutch, German, Japanese, Swiss, and UK banks. And as we all now know, these banks, their dollar assets tended to be a mix of U.S. Government debt and structured finance products, which proved much less liquid than their liabilities, and of course were longer term than their liabilities. So in contrast, their dollar funding had much shorter maturities, and maturity mismatches in dollar funding became a critical issue. And then this is we'll see in the specific case of Korea shortly. So that was the backdrop against which the turmoil ensued. Strains in funding markets first emerged in the middle of 2007 in the wake of growing unease about the exposure of banks to U.S. subprime finance and structured securities, reduction in the size of credit lines, hoarding of liquidity. This has been well documented in many accounts of the crisis. And there was a rise in the cost of unsecured funding, particularly difficult for financial institutions that were managing maturity mismatches. And these LIBOR OAS spreads became quite commonly used as an indicator of stress, and you can see in the second half of 2008 they skyrocketed, but they from about second half of 2007 they rose considerably, and then not just in the U.S. dollar but other currencies. The U.S. dollar was the most pronounced. Next up, FX swap markets. So the difficulties in the unsecured funding market caused financial institutions to turn increasingly to secured funding sources, including repo markets and FX swap markets. There the strains became evident. In the FX swap market, what we saw the conditions were tightening in response to this growing imbalance in the demand for and supply of dollars. So institutions that were rationed out of the unsecured market then rushed into the swap market. And this withdrawal was not, so more institutions switching to the FX swap market just as others were withdrawing, and which was not just a result of counterparty concerns, but also a deep-rooted preference to keep precautionary balances of U.S. dollars as the crisis expanded. And what we see is the supply and demand imbalance was reflected in a difference between swap-implied U.S. dollar funding rate rising above the reference rates. Here is a chart from one of the papers I've written with Naoko Baba at the Bank of Japan. But essentially, this is a chart of the different spread between the FX swap implied rate, or the implied cost of raising U.S. dollars from a different funding currency, say the euro or the Swiss franc or the pound in these three cases, and then using the swap market, and the difference between the implied cost of that versus just straight dollar LIBOR. And we see that as the strains in the funding market became distinctly sort of reflected in these deviations from covered interest parity conditions. Began in second part of 2007, from August, and then really entered a new stage, as we all know now, after the failure of Lehman. So policy responses to dollar shortages. There's four bullets here: use of foreign exchange reserves, reserve pooling arrangements, other multilateral initiatives, and then finally the U.S. dollar swap lines with the Federal Reserve. Foreign reserves, this certainly would make sense to rely on these because in part because of the very rapid growth over the past decade, so particularly notably in China, Taipei, Japan, Russia, Saudi Arabia, accounting for a 4 trillion of a 6.3 trillion increase. Here's a table in the presentation. This is again from this particular table is from a speech given by Steve Cicchetti just a few weeks ago. It's on the BIS website. But just documenting the huge increase in foreign exchange reserves, going from 14 for the countries in this table, from 6% of GDP at the end of '99 to 14% end of 2009. About roughly half held by the largest 5 countries. So this increase, of course, did not occur only because of the self-insurance motive, but obviously there were other causes, such as the byproduct of exchange rate policies. But that said, when the crisis came around, they were ready to use dollars. And in fact, during the crisis, many countries, including Brazil, Korea, and Mexico, used part of their reserves to help banks and non-bank corporations that were facing foreign currency funding cutbacks of the nature that were documented earlier. This is a chart that will be parts of it will be in the BIS annual report a month from now, but level of reserves sort of heading into the crisis, and then after the crisis, or the trough during the crisis. And you can see across a number of countries, again, including Brazil, Korea, Mexico in particular, we saw that they did draw on their reserves. In Ilya, part of the talk, we'll hear more specifically about what Korea did. A second means of possibly dealing with the foreign currency shortage reserve pooling arrangements. Here in this part of the world, we talk a lot about the Chiang Mai initiative, network of bilateral swap arrangements among Asian plus 3 countries. Also, a ASEAN swap arrangement is part of that. 20% is immediately available, the rest subject to conditionality, and that's a very important point. It was not used during the crisis by countries such as Korea, and I think reasons for that, the unconditional component was too small in a crisis. Korea likely didn't want to go through the necessary procedures for the conditional component, and the bilateral local currency swap arrangements were also too small or impractical. Now, the multilateralization of the Chiang Mai Initiative, or CMIM, that was agreed to in June 2009. It's operational this year, pulls together more money, and we might want to talk about whether that's might be better going forward, or this new arrangement, but it is really the topic of another presentation. There was also some progress on other multinational lateral initiatives. I certainly should tip my acknowledge the IMF flexible credit line introduced in March 2009 for economies with sound economic fundamentals and policies aimed to provide timely support. Within 1 month of the announcement of this, Colombia, Mexico, and Poland did signal interest and were granted lines worth $77 billion. These interventions, taken as a whole, likely help to stabilize major funding markets, but I think the principal avenue from the perspective of market participants are the most important policy measure were the FX swaps with the Federal Reserve. And let me talk just briefly about those before turning the floor over to Ilya. The Federal Reserve, in these swap lines, they met dollar shortages by providing U.S. dollars to the central banks, the counterparties, who then provided them to their counterparties under their jurisdiction. Started small in December 2007. It's important to remember that before the Lehman crisis, these swap arrangements had already begun. They gradually increased in size, and then after the Lehman bankruptcy, more central banks signed up across five continents, and then by December 2008, more than 580 billion in swap lines outstanding. So that was the peak, and this is the beauty of these arrangements was that sort of the provision of the funds of the dollar funds was determined, and the conditions under which institutions could receive those funds were determined by the central banks in the various jurisdictions. So the Federal Reserve didn't have to figure out which financial institution was eligible. They relied on that was what the ECB, SMB, BOE, and the other counterparty central banks, that was their call. So you had the central bank swap lines, and then you had the provision of the U.S. dollars against proper collateral according to the conditions of the local central banks by those central banks. And ECB, SMB, and the Bank of England were the first ones, but then, of course, as I mentioned, many more signed up. And here, this is the final slide, just to give you a sense of how the quantity, the cap of the swap lines, again, just looking at with the Federal Reserve and the three European central banks, ECB, SMB, and Bank of England, how that cap was gradually raised as the crisis unfolded and became more serious. And then on October 13th, to see the final set of bars there, on October 13, 2008, to these three countries, the swap lines became unlimited. And the market participants say that was sort of the turning point in the FX swap markets. So let me turn the floor over to Ilya, who will talk about the Korean case.